And so now that we've locked in the close on Friday, even though we rallied into, into today's trading, overall, this is confirming finally getting this downtrend in stocks. It's using longer term weekly exponential averages. So it takes a little longer to react. And that's on purpose. It's meant to minimize as many whipsaws as possible, but has just turned negative. So overall suggesting the longer term trend now more negative than positive. The last time it was in that configuration was the December 18 to February 19 period, which ended up obviously recovering, and that turned positive a couple months later. The more tactical side, the shorter term part of this, which is really more of a medium term read, is this weekly PPO. This is using the traditional settings of the MACD and PPO indicators, very similar. And so turned negative the second week in February, has remained negative in some ways, extremely negative, because it's going so far to the downside, and you can see the momentum there, those green bars that are illustrating that. But overall has remained in a negative trend, suggesting now the short-term and long-term trend still on the negative side. Daily chart of the S&P we've talked about, and again, the takeaway I'm looking at is we're in short-term. I see this as a short-term tactical bull move, but still within a long-term downtrend. I still think we're going to see further downside, a test of the lows, if not lower. I actually mentioned earlier, I tweeted, I think we'll see 2,300 before we see 2,800. We'll see. One of those maybe hit next week, even Monday. So hopefully we got a little time to see how that plays out. But that's sort of my expectation. I still think we have a lot more to digest. It's a process that I can't imagine would be over just yet. This is our next chart, looking at daily breadth readings using the cumulative advanced decline lines. And what I like to do is use this as a way of measuring, cap tier performance, looking at the larger versus the smaller companies within the equity space in the US, but also just a check on the overall market trend. So the chart of the S&P does one thing. What is the breadth telling us? And this is not updated yet through today's close. This is going through yesterday. We certainly had an uptick in these cumulative breadth readings. You can see across the board, they've gone higher. And this is large caps based on the S&P at the top. This is the small cap index at the bottom. But again, what strikes me with these is I still think they're in a downtrend overall, even with, this week so far sort of turning higher. The real kicker is when you get a higher low. And so on this next pullback, are we able to establish higher lows in the S&P, but especially in these cumulative breadth readings? So overall, saying, recognizing the uptrend, but not quite signaling a downtrend. A lot of the other breadth readings still, overall fairly negative. They haven't updated a ton since we got these really bombed out breadth readings. And this pattern with new lows going to extremes, with percent of stocks above their 200-day going to very low extremes. This is what has helped me make sense of this sell-off and think of it a lot less like the 2015-16 market and more like the 2008-2009 market. And again, I feel like the leg we're in is kind of coming out of those 2008 lows in October-ish before we broke down and hit the ultimate low in the first quarter of 2019. I feel like we're sort of between those two, potentially now, with another retest, another sort of pullback that could end up being a very viable move. Updating breadth, I think we missed talking about this yesterday. I try to remember to talk about this on Thursdays, but in sentiment is what I meant there. So the AAII ratings are based on individual investors and asking if you're bullish, bearish, or neutral on stocks. And overall, the bearish number has stayed pretty consistent, and the bullish number has come down just a little bit from last week, but overall pretty decent. I mean, a third of the respondents still saying that they're bullish on stocks, and that hasn't come down a ton. Now, before it was about 40, it was about 45%. So we're down, 12, 13% from that. So granted, that is coming down, but I would expect this to be a lot lower given how much we've sold off. And if you look back at, sort of the 2015-16 period, this bullish reading will get down to 20%, if not even a little lower, which is more what I would expect. So, the bulls have not come off. There's still a lot of underlying optimism about stocks that's being reflected here. And there haven't been new people voting on the negative side. What's interesting, the difference between those two has remained about 20%, and that's increased a little bit with the decrease in bulls this week. But overall, certainly favoring more bearish respondents than bullish. And if you look back, pretty rarely we have over 50% bears. That goes back to some of the historical bear market phases that we've talked about. Looking at some of the ratios, some of these have certainly dramatically given what's happened in the market, all the volatility that we've seen. This ratio of consumer staples versus discretionary, if this is going up, it's saying discretionary is outperforming, going down, staples outperforming. It's come up a lot. You can see it's come up a lot more on the cap weighted version at the top than the equal weighted version at the bottom. That's because Amazon is a big weight on this top cap weighted version. It's a big weight in the numerator, basically. So Amazon holding up. It's sort of a coronavirus play, because I don't know about you, but a lot of people ordering more than ever on Amazon. You can see Amazon Prime now means a week or two and not a couple days. And on the equal weighted version, that recovery in Amazon is muted relative to other names. Just a couple other quick things I want to do because we're almost out of time here. I did want to point out this theme of small cap underperformance has not alleviated. And so, even in a defensive environment versus the offensive environment, small caps have continued to underperform. So, from a technical perspective, I think it'd be hard pressed to justify owning small caps anytime soon, just based on that continued underperformance. The growth story has still been working. And I think, talking with some of my guests this week about Matt Maley in particular, talking about technology yesterday being offense and defense, you see the XLK hold up really nicely on a relative basis. And I think that's part of it. And then the last one is just to illustrate the dollar has weakened significantly in the last week. This has led the U.S. to be underperforming ACWI, underperforming the global equity index. Whether or not this is a pullback and we turn higher, I think it's an interesting chart to be watching right now, along with this one. This is what's really hurting things. This is EM underperforming EFA, so emerging markets underperforming developed markets. And that certainly speaks to the weakness in oil and challenges with a lot of non-US markets on the emerging side.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.